I'm here in Zurich for the UBS Global Family Office Day, and joining me is Sara Ferrari on the very cold deck of this hotel. She heads up the bank's Global Family Office. We are looking at family office business, Sara, thanks so much for joining us, that is growing and becoming a really successful piece of the bank's P&L. Talk to me about why that is. Why are family offices, which started with, like the Rockefellers in the 1800s, all of a sudden booming, in this century?
Well, first of all, as you say, it's a relatively recent phenomenon, right? In some regions, like in Europe and in the United States, you have family offices that have been managing family money for generations. But if you look at some of the statistics, for example, in our family office report, 70% of the family offices that we have interviewed have been founded in the year 2000 or later. Clearly, in Asia, the industry is growing very fast, but Asia is still a bit behind. Most of the family offices are still in Europe and in the US. The reality is a couple of things, I would say, that are driving the increase of family offices. First of all, increased sophistication in the way families manage their money. There's clearly an increase in wealth. There have been a number of liquidity events over the past 20 years that have resulted into very significant pool of liquidities that do require professional type of management. So
hang on, are you saying that people are just getting wealthier, that we're seeing a lot more sort of multimillionaires and billionaires that need this?
That's part of the equation, and the other part of the equation is there's more liquidity as opposed to money tied up in operating companies. Right? So
because normally very wealthy people, I read your survey, come from, say, manufacturing families.
Most of them come from operating companies, right? And with the generational transition and companies being listed or stakes in companies being sold or the entire operating business being sold, then families have this huge pool of liquidity that they need to manage in a professional way. And generally what we say is when this pool of liquidity becomes higher than between 100 and 150 million, then it does make sense for families to set up a professional structure that can, to a different degree of outsourcing and insourcing of investment activities, managing the money in a professional way.
Let's talk about what they're doing with that money, because it looks like the trend is going away from hedge funds. They weren't making enough money for them. Maybe the fees were too high, so family offices are getting out, but still very much involved in private equity, and maybe that could increase. Is that the case?
It is the case. To be fair, if you look at the survey that we have done now for 5 years, hedge funds have been on a decreasing trend for at least the last 3 years, driven, as you say, by a cost versus performance equation that is not particularly satisfactory for families. Keep in mind, though, that hedge funds represent only roughly 6% of the overall allocation. So yes, the trend is downwards, and it's not very different from what you see on the institutional side as well, right, with a lot of outflows in the recent years from hedge funds. On the flip side, private equity has been steadily on the increase, both on the direct investment side and on the fund side. So clearly families are, if you want, more attuned. If we go back to a lot of families come from operating companies. The beneficial owners clearly do understand investing in operating companies. They feel they are closer to the activity of the businesses they buy, and therefore direct investment has a clear appeal. Having said that, we have seen while a lot of families and family offices continue to indicate that they want to increase exposure to direct private equity investments, it's always difficult to find the right opportunity. So the sourcing side is complicated, and the due diligence side is complicated as well. So co-investments alongside institutional investor or other large families has become an increasing trend on the private equity side.
Let me ask you a question that's outside of the business that you're normally looking at and more about the business of global family offices. You run the global business for UBS, but you're somewhat of a rarity in that you're a woman. In fact, there are far fewer women running family offices than there are running investment banks or other asset management businesses in banking. Why is that?
That's actually a very good question.
And can it change?
Why is that? Why is it that women are represented in general in financial services or in many other industries, technology, manufacturing? So I think it's a sort of a common problem across a number of industries, not specifically to family offices, to be fair. Can it change? Hopefully, yes. We have started looking at statistics on gender diversity in family offices. We now see that a small minorities, but at least some of the family offices we have interviewed do have gender diversity targets. And there is a new generation coming in particular in Asia, with a lot of family second generation after the founder that have a significant number of very senior women, and the hope is that when they will take the helm of the family and the family offices, that will progressively increase the female representation in family offices as well.
I mean, the reason I ask is not just because it would be the right thing to do to give everyone an equal chance regardless of gender, but because it would make sense that if you have a more diverse group of managers, you could increase your opportunities to make money.
Yes, that is, I think, the key rational consideration behind gender diversity in general for family offices and every other type of investors.
And for companies as well. Sarah, thanks so much for joining us. Really appreciate your time this morning. Sara Ferrari here, head of the Global Family Office at UBS.